Okay, so there's a new jewelry IPO hitting the market, and this one's got a name with some serious history behind it. We're talking about PNGS Reva Diamond Jewellery. The big question, of course, is this a real gem for your portfolio? Let's dig in.
And that's really what it all boils down to, right? Are we looking at a brilliant investment, a real diamond in the rough? Or is it just clever marketing making glass look good? That's exactly what we're going to figure out.
So over the next few minutes, we're basically going to open up the jewelry box. We'll examine the sparkle, but we're also going to look for any scratches. We'll check out the good, the bad, and, of course, the numbers to see if this thing really shines. All right, first things first, let's get down to basics. Who is PNGS Reva, and what exactly is this offer all about?
So you'll see the brand name Reva, but here's the key. It's tied to the PNGS legacy, Gadgil. And in the jewelry world, that kind of legacy means trust, which is, well, it's pretty much priceless. They're laser focused on diamonds and precious stones, and their main playground for now is Western India. Okay, if you're even thinking about this one, you gotta get your calendar out. The window is super tight. It opens on February 24th and shuts just 2 days later. Things move fast after that. Allotment is on the 27th, and we expect it to start trading around March 4th. So, yeah, no time to waste.
Okay, let's start with the good stuff, the bull case. Why are people excited about this? What makes this a potentially glittering opportunity? Time to examine all that sparkle. When you look at their strengths, they're really built on some smart foundations. First up, that brand history we talked about, that creates instant trust. Then, they're not trying to be everything to everyone. They're focused on that growing diamond market. But here's what I think is really clever. Their expansion model is asset light. It's a mix of their own stores and franchises. Why does that matter? It means they can grow without burning through a mountain of cash, a trap that a lot of retailers fall into.
And it's not just about what they're doing internally. They've got some serious tailwinds pushing them forward. I mean, think about it. The Indian wedding economy alone is a massive, non-stop engine for demand. Plus, you've got this big shift where people are moving away from the local jeweler to trusted, organized brands. And then there's the huge untapped market in all the Tier 2 and 2-3 cities. It really feels like they might be in the right place at the right time.
But hey, let's be real. No investment is perfect, right? Every diamond has its flaws. So now we have to flip the coin and look at the other side, the bear case. Let's dig into the risks, the scratches that could tarnish this whole thing.
So, looking inside the company, there are a few things that give you pause. For one, they're really concentrated in Western India. That's a risk, because if that region has an economic hiccup, it's going to hit them way harder than anyone else. This is also a business that just eats up cash. You have to have a ton of money tied up in inventory. And remember this one, the slice of the IPO pie for retail investors is tiny. That means getting an allotment can be really, really tough for the average person. And then there's the stuff outside their control. The threats here are very real. Gold and diamond prices, they can swing wildly, and that messes directly with your profits. And what about lab-grown diamonds? They're getting better and cheaper, which could totally disrupt the whole market. Oh, and you're going up against absolute giants like Tanishq, and maybe the biggest one of all. Jewelry is a luxury. When times get tough, it's one of the first things people cut back on. Okay, so we've got the story, the pros, the cons, but the billion-dollar question, or I guess the 1,000 crore question is, do the numbers make sense? Let's dive into the valuation. All right, let's talk about what it'll cost you to get in. The price band is set between 367 and 386 rupees a share. You have to apply in a lot of 32 shares, so your minimum investment, the smallest ticket you can buy, is going to be just a bit over 12,000 rupees. Now for the really crucial part, the valuation. After the IPO, the company will be worth around 1,224 crore rupees, and its PE ratio, or price to earnings, is sitting at about 15.4. Now, all that really means is, for every 1 rupee the company earns, investors are willing to pay about 15 rupees for the stock. It's a quick way to see how expensive a stock is. So is that 15.4 PE ratio high or low? Well, let's put it in context. The average for its peers, other similar companies, is closer to 18. So at around 15, PNG's Reva is actually being priced a bit more, let's say, reasonably. And this is a super important point. It suggests they're not trying to launch this with a ton of speculative hype built into the price. Okay, remember when I said getting shares might be tough? Well, this chart shows you exactly why. A whopping 75% of this IPO is reserved for the big guys, the qualified institutional buyers. The slice for retail investors like you and me, just 10%. That's it.
So you can bet competition for that small slice is going to be intense.
All right, we've looked at the sparkle, we've looked at the scratches, we've crunched the numbers. So, where does that leave us? What's the final verdict?
There's a line from the analysis that I think just nails it. This is not a screaming bargain, but it's not ridiculously overpriced either. It's right down that middle lane, where the company's story doesn't matter as much as its ability to just get the job done. It's all about execution from here on out.
So, when you balance everything, the reasonable valuation and the growth story on one side, and the very real risks on the other, we land on a final score of 7 out of 10. Now, that's a pretty solid positive score, but it definitely comes with a few buts attached.
So the big question is, shouldn't you apply? Well, it breaks down like this. Applying for a potential listing pop and maybe a medium-term hold could make sense if you're okay with the ups and downs of consumer stocks, you get the risks tied to gold and diamond prices, and you actually want a piece of the jewelry sector in your portfolio. But on the other side of the coin, if you'd rather wait and see how the market reacts first, or if things just feel a little too volatile right now, then there's absolutely nothing wrong with sitting on the sidelines and watching for a bit.
And really, that's what it all comes down to. The company has its plan, no doubt, but the market has its cycles. So for PNGS Reva, which one is going to shine brighter in the long run? Their strategy or the market's mood? That's the real question, isn't it?